Good morning, everybody, and welcome to our November 2024 IFRS and corporate reporting webinar. I just had over the weekend, my youngest children, twins, have finished year 12 exams, and we had a bit of a family weekend. And and I was just reflecting on how quickly life goes by and how the years speed by, because here my babies, the youngest of my kids, are finished with school. And then at the same time, I started to think about, we should, as children do, they talk about Christmas presents. And then I did a few calculations, and Kevin, I've realized it is 4.5 weeks until our office closes for the Christmas break and the end of year. And that didn't help me at that stage to relax over the weekend. This year has been so fast. And here we are on the 20th of November. I think the office is closing in a month on the 20th of December. I hope that your year has been enjoyable. I hope you are getting ready for some downtime, all of you. And today, believe it or not, we are talking about financial and sustainability reporting update for those getting ready for 31 December 2024 reporting. In a way, it feels like COVID was just yesterday, and that was 2020. It's years ago. Anyway, that's my kind of reflection as I'm getting older and my kids are getting older. I have more time to reflect on these things. But the reflecting doesn't make me calm. It freaks me out, to be fair. Kevin, good morning to you. Wonderful to see you.
Morning, Aletta. It's lovely to see you. And I thought you were going to say that you spent the weekend calculating the carbon emissions in the Christmas presents. That's where I thought you were going with your comment, which probably shows you where my mind is. I haven't quite stepped out of the carbon accounting. I seem to be embedded in that at the moment. So I'm glad that you're not completely overwhelmed with carbon and that you're working out the emissions in your Christmas presents. That's good. I do share the sentiment, though, that this has been an extremely quick year. I mean, I think we're actually having the best year of our life in terms of stimulating our technical competence and moving forward on a subject matter, and the industries, everything's moving forward. So in a way, it's exciting, but I must admit, I am looking forward to the break on the 20th of December. But that means there's a bit of work to do before then, and that is getting ready for your 31 December reporting period. So that's what we're going to talk about today. So good to see everybody.
Yeah, absolutely. So, as always, Kevin is joining me. He's a partner in IFRS and corporate reporting based in Sydney. But similar to me, he has over the last number of years embraced sustainability, all things sustainability. And he does a lot of work around carbon accounting and mandatory sustainability reporting. So please reach out to us if you need assistance in that space as well. We would like to begin by acknowledging the traditional owners of the land on which we meet today, and we pay our respects to elders past and present. I'm on the land of the Wurundjeri people of the Kulin Nation. And we also extend that respect to the Aboriginal and Torres Strait Islander peoples here today.
And I'm on the land of the Gadigal people.
Fantastic. Thank you very much, Kevin. Also, if any of you would like to put in the chat box where you are, that would be amazing. I think it's important that we, share that knowledge through our group. So you're welcome to put it in the chat. It would lovely to see where you are. I would also like to use this opportunity to promote a not-for-profit version of this webinar, which is running on Monday, the 25th of November. So today we will not be looking at not-for-profit specific items. I should say most of the things we cover today will also apply to not-for-profit entities. So this not-for-profit webinar on Monday is looking at additional not-for-profit specific items. And I'll be presenting that with Elizabeth Blunt, who's our national not-for-profit leader at BDO in Australia. You can click on this register now, and it will take you to our website, and you can register for that webinar if you're a not-for-profit entity. I would also like to use the opportunity to promote our 2024 sustainability report. And it's all about progress, opportunities, and impact. As you know, this would have been our third sustainability report in 2022-2023. My team and I prepared the sustainability report. However, this year it was prepared by Cara, who is our Chief Operating Officer at BDO Australia. She's taken this big task on, together with the amazing Melissa Simmons, who's always been helping us with this work. It's an amazing report. One of the things, I like pictures and graphs, and you can see even there on the front page, the report includes a number of Australian landscapes because we wanted to make it uniquely Australian, because you could pick up BDO reports from a lot of countries where BDO operate, and we wanted people to know, but this is the Australian one. It looks like Australia. It feels like Australia. There are even a kangaroo, or there's even a kangaroo somewhere in there. But I don't want to talk about kangaroos, Kevin, because as you know, I had a nasty encounter with my new electric vehicle and a kangaroo last week, which gave me a big fright. So I don't want to talk about kangaroos at the moment. But there's even a photo of a kangaroo in there. It's a wonderful document telling you all about BDO Australia and what we do around sustainability. So well done to Cara and Melissa. We are in the midst of our carbon accounting masterclasses. Yesterday, Kevin and I were presenting the virtual carbon accounting masterclass, and there's 2 left. On Friday, I'm doing the carbon accounting masterclass here in Melbourne. Not too late to register. And then on the 10th of December, Tuesday the 10th of December, the final masterclass of this series in Perth. Now, the demand for these carbon accounting masterclasses are extraordinary, and therefore we will be looking at scheduling another series of masterclasses, I would think in March next year, as everybody's gearing up to measure their carbon footprint and the new mandatory reporting. So we've done a series in May this year, another series in November, December, I suspect another one in March. So you are still welcome to register for the Melbourne and Perth ones. Our monthly IFRS and corporate reporting webinars, today we are looking at this update, getting ready for 31 December. And then in December, we'll be looking at the new IFRS 18. About presentation and disclosure in financial statements, and we'll give you a bit of a sneak peek. Actually, just earlier today, I've shared on LinkedIn our new BDO publication on IFRS 18, which includes decision trees, diagrams, worked example, beautiful publication. It was prepared by BDO Global with input from all the various countries, including BDO Australia. But if you go on LinkedIn, you'll already see it there. Please join us for that last one. It's our Christmas present to all of you is a new IFRS 18. Then next week, we're also doing our next sustainability webinar. And next week, Wednesday, we're looking at setting climate-related targets. Now, you can see this year we've been through a big journey. Since January that we've heard about this new legislation, it's been a real journey to work through AASB S1, S2, the legislation. And next week, we look at setting climate-related targets. And then we round off the year on climate-related disclosures in Australia. So looking at legislation and looking at AASB S2. The other thing I should say at this point, I think my deadline, or our deadline, Kevin, for scheduling our IFRS and sustainability webinars for next year is the 25th of November, which is Monday. Can you believe it? We're thinking about topics and scheduling webinars again, which is super exciting. So shortly, you will all receive invitations to our upcoming webinars for next year. I can tell you at a very high level, the thing that everybody's talking about around sustainability is getting ready for AASB S2, the mandatory standard. So I suspect all the webinars next year will focusing on how can we educate and assist you through the webinar process on getting ready for AASB S2. As you know, Kevin and I, but also at BDO, we lead through education. We think education is the way to get clients, going in the right direction. And then we can always assist if additional support is required. Today's agenda. So it's a top 10 agenda. We're going to start with an ASIC update, which is really important, our regulator. Then we'll recap consolidated entity disclosure statement for public companies. We'll look at some hot topics in the profession. And then the fourth one is we'll go back to sustainability update, incredibly important. How does that fit into the annual report? We'll then look at the classification of liabilities as current versus non-current, which is becoming effective 31 December. We look at standards applicable for the first time in the half year and full year 31 December 2024. We'll look at standards issued, not yet effective. Recent IFRS agenda decisions, just flag them. If they're applicable to you, you can engage with them more closely. An update on registrable superannuation entities, as well as hyperinflationary economies update. So that's the 10 sections we'll be covering today. As you know, this webinar traditionally is a longer one. It's been scheduled for 90 minutes because there's usually a lot to cover. And we could never fit it into 60 minutes, Kevin. So I think we've got an appropriate time today. So Kevin, I'll hand over to you to look at the ASIC update. Thank you very much.
Thanks, Aletta. And there's a lot as always. And just for those of you who maybe haven't done preparing for webinar with us, as Aletta said, it's 90 minutes. And the way we do it is we almost throw too much at you. But in the webinar, we only deal with some of the key messages to take away. So really, this is the one webinar where you actually have homework. And the homework is that you need to follow all the links in the presentation. They take you to websites or BDO's thought leadership on all these topics to give you further information. So the idea is for us to trigger in you a thought bubble that, does this apply to me? Do I need to deal with this for my 31 December 2024 reporting? And do I need to do further investigation on my own? And that's what all the links are in all the sections. So we won't do everything on every slide today. We'll kind of do a helicopter session. But please then take away the bits and pieces that are relevant to you to prepare for 31 December 24. And hopefully, if you've already started to think about your December reporting, this just triggers almost a reminder to cover the things you might have missed. If you're learning about something that applies to you today for the first time and you've got a 31 December reporting period, that means you need to get on to it really quickly. And that's what the links will lead you to. The other thing is probably pointing out is that we probably are focusing very much on 31 December year ends today. That's the idea, although obviously some entities will be doing their half year reporting for the 30 June 25 year end. But I guess the key focus today is, are you preparing for a year end, 31 December 2024 year end? And then we'll focus a little bit on that in terms of what applies to you for the first time in the way we do this. Let's look at the ASIC update. Why do we always start with the ASIC update? Because it's a good indication of what the regulator is looking for. And if it's important to them, it should be important to you. It's not necessarily important to everyone that ASIC is going to come knocking on your door and ask questions. Not everyone has experienced the luxury of an ASIC surveillance. But it is a good indication of, if it's important to the regulator, you should be focusing on it too, not only to make them happy, but to make the users of your financials happy. And the big outcome from the most recent ASIC surveillance, which came out in October 2024, which is quite recently, it feels like 100 years ago, but it was only last month, is that they have adjusted, or their surveillance program has led to something like $1.8 billion of adjustments to financials. I'm astounded by that number. I hope I've read that right, which is basically surveillance by ASIC of preparers of financials questioning something which led to an adjustment, a restatement, maybe an adjustment in the following period, which means they got something I don't want to say wrong, but something was inappropriate, which needed to be looked at again. And once again, the old concepts, impairment, provisions and expenses, revenue recognition, failure to consolidate a subsidiary, a whole new level of what happened there. And then also some of the other enforcements, which are later in the section that we'll deal with. So many of these are not new. We won't spend a lot of time on them. I think the one I will probably kind of just aim at is revenue recognition. The big issue of the day is agent versus principal. There's been a number of those, and some of them have been surveillance questions from ASIC, which didn't relate to new transactions. It actually related to past practices which got queried. Hang on, you've got this arrangement, you've been accounting for it one way for some time, but it doesn't seem right to us. Let's have a look at that. And they've actually realized that it was being accounted for inappropriately for some time. So you don't need a new transaction to be getting that wrong. If you've got an agency or a principal type question, in other words, somebody else is involved in the delivery of a service to a customer, almost like a third party, you really should be saying to yourself, am I the agent or are they the agent? And what's happening here? And it's not as clear cut as you would think. So really go and check that agent principal arrangement. Make sure you've got your assumptions right, even if it's an old arrangement that you've been reporting for a number of years, and have a look at the ASIC reports, because they give a lot of guidance on the key triggers and factors to think about, which may actually help you then make sure you've got that right too.
Stephen,
Yes,
if,
Aletta.
if I could add something, maybe on revenue recognition, but actually in general, sometimes, entities have done a position paper, which they should do on complex transactions, and it was appropriate at the time. But then, it's an equivalent of a scope creep, but we start to do different things under that arrangement. Maybe the contract is extended, amended, modified, or we start to do more things outside the contract. And then often, finance teams don't sit back and say, is that original position paper, is that original accounting treatment still appropriate? So I think, yes, it's fantastic, and we should, whenever we enter in new contracts, especially significant ones with significant revenue impacts, we should have a position paper, but we should also consider whether those original position papers are still appropriate for current circumstances. And so we often see that as a bit of a trigger. Revenue recognition, agent versus principal, we know under the new IFRS 15, there were additional guidance around agent principal, and they had two goes at it, right? There were initial guidance, and then they changed the initial guidance to more specific guidance. Yeah, so it's been problematic from a standard setting perspective. There's been some IFRS gender decisions around agent versus principal. So I think it's important to consider that. And maybe the principle of, if circumstances change, are we still happy that our original position paper assessment is appropriate?
Yep, that's a good one. Thank you, Aletta. On the key observations from the finance findings, which I think is in the next slide, some of the old what do you call them? We see them all the time. They're not new. And I get worried a little bit because we keep seeing the same things over and over. And I feel like there's a bit of complacency settling in. But I'll just run them through very quickly. The OFR risk discussions, this is about the operating financial review risk discussions that go into directors' reports, etc., for listed entities. There's a reason why that's at the top. It's a portent of things to come in climate reporting. Climate reporting and this mandatory sustainability is by definition really just a business risk. Climate risks and opportunity are really business risks and opportunities. And the OFR risk discussions are discussions about material or significant business risks. So kind of climate risk should already be in there. And I think what ASIC has noticed through its observations is that even an old requirement to discuss risks in the OFR has been done poorly by companies, and poorly because the risk isn't clearly articulated. it's not really clear how that risk could impact performance and profitability and earnings, and there's really not really much disclosure about what the entity is doing to mitigate it. But that's the same thing we're moving to in climate statements. There's a lot more in climate statements, but the base concept of climate reporting is really climate as a risk to business. So think about the OFR risk discussions as a way to prepare for climate disclosures as a way. Can you articulate your risks? What are you doing about them? What is the impact on performance if those risks materialize? And are you able to actually articulate it in the OFR? Because also part of this is actually communicating that to investors in the OFR. And entities are really, really poor at doing that. So that's really one of the observations there. Aletta will talk a little bit about mandatory reporting later, but I'm really passionate about getting the OFR risk disclosures right. And I want to say, even if you're not required to do OFR disclosures, have a go at it just to practice, because everyone's going to have to do that at some point, and we're going to start with climate as a business risk. In terms of some of the other ones there, I don't want to talk about impairment, but I want to talk about impairment. I could spend a whole webinar on impairment. But asset valuations, making sure you're getting the inputs and assumptions into your impairment calculations correctly is really important. And then the non-IFRS profit disclosures and the financial report disclosures. Non-IFRS, this is aligning the IFRS lines, like operating profit before tax and everything in your statement of profit and loss, with things like EBITDA and underlying profit and normalized profits, all those wonderful things that everyone kind of makes up to try and remove, shall we call it, the one-off or the normalized items. And that is also what IFRS 18 is about, which is coming down the pipeline, is to try and bring together IFRS and all these other measures that organizations use. There is actually information from ASIC on how to reconcile and talk about non-IFRS information in your financials and in the publications that go with financials. I think the rest is going to come up as we go. So I'm going to pick up the pace a little bit, because noticing the time, we're languishing a little bit on the ASIC update. Key areas here, or the additional items I'd like to highlight: previously grandfathered large proprietary companies. Let's just make a blanket statement. If you're still not lodging because you are previously grandfathered, you've probably got that wrong. The grandfathering provisions have been essentially grandfathered out or eliminated. So, and I still get questions on this. Do I need to lodge accounts if I'm a grandfathered entity? And the answer is probably, most likely, or it is yes. The grandfathering provisions don't apply anymore, at least the way you think they do. Lodgement with ASIC on registrable superannuation entities. We'll come to that at the end of the presentation. Climate risks are going to come up later on in the sustainability section. And then the next one is requirements for consolidated entity disclosures. And I will spend a bit of time on this in the next section. So I think I'll leave it at that, Aletta. These are the areas we need to look at. In terms of the last few slides on this, we've actually given you some links to very good ASIC enforcement media releases. So this is part of your homework. Nothing on here I haven't mentioned already, other than perhaps to talk about the fund management and the investment credentials. ASIC has targeted a particular sector of the industries. This is where we're talking about fund management and investment. They've had something to say about the greenwashing in that sector, but the concepts there apply equally to everybody else. Saying things that aren't true or emitting things to hide the success of your climate and or environmental initiatives. And this appears in the media almost on a weekly basis. I'm now seeing an article about someone overstating their progress or commitment to environmental credentials and actually getting caught out by not only ASIC. I think you'll also notice that the investors are starting to hold these companies to account themselves directly. And so that's maybe just something to kind of take into account. Right, Aletta, do you want to say anything on the greenwashing before we move on?
No, I agree with what you've said, Kevin. I just think as the whole Australian economy is moving forward, getting ready for mandatory reporting, and everybody's measuring their carbon footprint and sharing it with customers, investors, financiers, there's more question marks around this. So you're giving me this information privately, publicly. What have you done to make sure it's correct? Is there assurance over it? share with us your basis of preparation, share with us the uncertainties. There's definitely a bigger focus. Unreal how it's developed this year, Kevin. The draft legislation was the 12th of January this year, and I didn't think that draft legislation can cause what we've seen this year. Yes, it became final legislation, etc. But wow, what an avalanche!
What an avalanche, absolutely. Isn't it just fun? All right, the last slide here is links to BDO's corporate reporting insights. Now, I won't refer too much anymore to the links in the rest of the webinar, but this is just an indication of how we've organized the slides. Just about every topic I've mentioned in this section so far, BDO has a media release, and Aletta does an amazing job to get the team to get these out there. So Aletta, thank you for that. But these are links to the BDO website on these particular articles. Go and have a look at one or two of them here. And the one I would point out a little bit is the agent principal considerations. There's a fairly detailed article on that from April 2024. Right, let's get into some of the really exciting topics. The consolidated entity disclosure for public companies. I have done a fairly detailed section in a previous webinar. In fact, I think it was preparing for the 30 June 24 webinar. So if you want to go, actually feels like the other day, nothing has changed here. It's just that it's effective now, and you need to make sure in the 31 December, if you're a 31 December report, that it's in, that applies to financial years beginning after 1 July 2023, which means for December year ends, you're up, you're there. And it applies to public companies only, but public companies include unlisted and listed public companies. And what this does is it's further enhanced disclosures around the structure of tax arrangements in order to make sure essentially various stakeholders, investors, and the ATO can understand how your affairs are structured from a tax point of view, and the obvious focus is on multinational companies. What this does is it essentially brings additional disclosures into these companies in terms of their holdings in subsidiary companies and other companies all over the world. So it's basically disclosures around your subsidiaries and other companies that are essentially in your group, but a little bit more disclosure than the accounting standards require, so that we can dig deeper into the tax arrangements. Now, this doesn't get a lot of airtime for some reason, but I think this is actually quite a fundamental shift in disclosures. But it's not even only that, your director's declaration has to cover this too. In other words, the directors actually have to sign a declaration that the information on this is true and correct. Now that's big, because it's more than just true and fair. So you can't hide behind, oh, it's materially correct. You actually are making a director's declaration that the information is true and correct, meaning you've got the processes and systems in place to make sure that the disclosures are complete and true and correct. You can't hide behind materiality here. It has to be right. And the director's declaration has to sign off and say that. Let's have a look on the next slide what the disclosures are, Aletta, and then you'll see what I mean about making sure you get this right. Not only do you have to make the disclosures that might be required in the accounting standards on investments in other entities in the group, but you also have to put things like whether the entity that you're invested in is a body, corporate, partnership, or trust. That's so much more information than we had to do before. Whether the entity was a trustee of a trust partner in a partnership in a joint venture with the consolidated entity. So essentially getting a bit more details about those joint venture arrangement and what's really going on here. Where these body corporates are incorporated, think tax havens, essentially making, which islands or some sort of tax havens is this entity or body corporate incorporated. The percentage of the issued share capital held directly or indirectly. I think a lot of entities probably do that already to some degree. And then we get into some of the income tax disclosures, whether it's an Australian resident or foreign resident within the meaning of the Income Tax Act. And then we get into foreign jurisdiction disclosures and residency disclosures. Interestingly, The last two are actually harder than you think they are, because what
Mm.
you actually have to do is establish controls to understand and define the body corporate you're invested on and how the Australian income tax defines that other body corporate and whether they are defined as a foreign resident or resident under Australian legislation. So you can't claim that you've got an investment in the Cayman Islands, for example, but you're not really sure how it's classified under the Income Tax Act in Australia as resident or foreign resident. You actually have to go and find out. And it turns out a lot of organizations are not ready to make these disclosures because it turns out they don't actually have this information. And I'm talking specifically about companies that are invested or have holdings in other jurisdictions where the family member that established the company hasn't quite informed the company on what these holdings are. And I can think of one very high profile company that's currently in the media where arrangements with that company in foreign jurisdictions have led to some really awkward questions about the tax arrangements and also about the related party transactions with the entity involving directors and management that didn't quite make it to the company level for disclosure. Now, treating you really carefully because I'm trying to not say any I'm not saying anything's gone wrong. I'm just saying there's a lot of media attention around this already. And part of this is going to be driven by this type of disclosure. So please make sure your systems and processes are capturing this information so you can make these disclosures in your financials in the current year.
And Kevin, I think what we've seen, although this is a disclosure in an annual report, you know, the people that are really helping clients here are our tax partners.
Yes.
So I think clients will have to make sure that you engage with your tax professionals who will have a good idea of your structure and your group, and especially those who help you with transfer pricing arrangements. You know, so those tax professionals that can help you with the meaning of Income Tax Assessment Act, you know, that's not Kevin and my speciality.
No.
I would say we have somewhat of a superficial knowledge of that only from years ago when we studied and maybe when we speak to tax partners, but please get those tax partners and professionals involved.
Yeah. And directors and audit and risk committee people on this webinar, you should be asking your management on the processes and systems they have under on this to make sure that the information is true and correct. The rest of the slides in this section cover pretty much what I've been speaking about already. It's public companies. There's a higher hurdle on true and correct. The one thing I haven't mentioned is probably in the middle of the slide deck here, which is where do you put this in the financial statements? Our recommendation is to include after the notes the financials, and the reason for that is the director's declaration is a different hurdle in terms of what you're signing off on. The director's declaration for normally covers a true and fair, whereas this one's true and correct. So you want to be able to isolate which part of the financials is subject to the different level of the director's declaration. And that's the reason why directors and audit and risk committee members is you need to make sure your management team have put the controls and processes in place to get this information right, because you'll be signing off on it. And that's our Christmas present to you. All right, Aletta, I think that was great. We should do that again sometime. I'm sure we will. In terms of hot topics in the profession, I've moved along a little bit, Aletta. Oh, we've got some links there, sorry. Hot topics in the profession. Look, I think here's what we're going to cover, and I'm going to kind of go through it really quickly. So the reminders here is essentially the agenda for the next few sections. How to account for Australian carbon credit units, material accounting policies, Pillar 2 income taxes, contingent considerations to vendors in a business combination, cash equivalents, and common disclosure mistakes in financial reports. None of this is new. We've covered this to some degree in previous webinars, and every single one of them has a video link to an article or a thought leadership piece that we've done previously. So I'm going to highlight at speed some of the key messages. Let's talk Australian carbon credit units, ACCUs. I always trip over that. ACCUs, the big issue is if you hold these, how to account for them. And it's really, is it inventory or is it an intangible asset? in many ways, the development of the policy is driven by what you've acquired them for and what you hold them for. So there isn't a tangible right on. It's got to do with whether you hold these things in the ordinary course of business. Either what are you going to do them, use them, or consume them in the ordinary course of business, such as inventory, or whether you're holding them for some other type of reason under intangible assets, like maybe you want to trade in them, which also triggers a whole bunch of other considerations, like do you actually have revenue contract in place? So there's a little bit of craziness going on here, but you just need to bed this down, and it's one of those scenarios where your use and intention might change every time. So I don't think this is a policy that necessarily sticks in place. I've had some companies who were acquiring or they were generating ACCU carbon credits 3 years ago. They were kind of superficial and maybe just maybe there was incidental to their operations. Now they've actually moved into a different realm where they're actively creating these things in order to either use them or trade them because they're becoming significant to the business. So the classification from inventory and intangible has started to change. So just make sure you're across. Why do I hold these? What's my use and purpose here? Have I classified these correctly into the various categories? And I think we've got some links on this. There's another thing I want to put on the agenda quickly, Aletta, and I'll come back to you, but I just want to finish this thought. The question about whether we can fair value these has come back up. Now, up until this point, and I still think our policy, Aletta, and you can correct me wrong in video, is that these are cost because there isn't an active market for them. But we are getting that question again on, is there actually an active market for these? And can we start to revalue them under the intangible standard? So I'm not going to espouse a position today on the webinar because I think it's too soon to actually go down the path of whether that is the answer, but I know it's firmly back on the agenda. And if you are looking to revalue this, you need to check in with myself and Aletta or your professional in this to make sure you've got a rock solid approach to determining this. Aletta, do you have anything to say on that?
Yes, so I actually wanted to say, Kevin, as you know, our regulator ASIC has a very firm view that there is no active market for intangible assets, any intangible assets in Australia, that would therefore allow entities to fair value those. And I think a lot of the argument has always centered around, yes, I can buy and sell these items, but is there something similar to a stock exchange where I can at any stage buy and sell and trade, right? So is there a stock exchange for carbon credits, right? And that's always been the position, I think, and that's been the thinking.
Still the position, I think, yeah.
Yeah, and I think it's still the position. So a lot of people have said, listen, but I can buy and sell it. That's not the question. An active market is if there's a platform where I can actively buy and sell yes, at any date, any time, right?
And the reason for it is also partly driven, Aletta, by the ability to see live information. Because yes, on a platform, you can see buy and sell and recent trades. But sometimes when you're buying and selling intangibles between parties, they are by contract between those parties, and the information isn't publicly available, and it's not live, and it's not. So that becomes the issue. This is a reliability of measurement issue, not so much, do we have a market for them? Of course we have a market for them, but can you price this at a fair value that's reliable? And the conditions often come back to, with the stock exchange, you can see live buy and sell information. You can evaluate whether it's a liquid market, and those sorts of things become easier to see.
And that's why having a market is different to having an active market for the purposes of fair value of intangible assets.
Yeah,
so we're on the same page. I think the other thing that I wanted to say here, Kevin, is that you can see here we've done 4 articles over 4 months recently. It's a bit of a series on accounting for Australian carbon credits or carbon credits in general, because IFRS accounting standards have not contemplated these things. We are trying to find the right place, and we're trying to apply IFRS accounting standards, let's say by analogy. So it's a difficult process. I know these matters have been raised with IFRIC as well, and it's coming up, and I think it will come up more and more. So just watch the space. We have a few more articles in this series coming. It's a hot area, and it will get hotter, excuse the pun. But it's important. There's a lot of different angles to this. So am I generating these carbon credits, and what are the consequences of that? As opposed to, am I buying these carbon credits? And then also, if I'm generating and or buying them, what do I do with them, or what do I intend to do with them? Do I want to sell them to somebody else, or do I want to use it to reduce my own carbon footprint? There's so many angles. It's not a simple answer, but these articles are giving you a few things to think about.
Right, then some of the other ones we have, thanks Aletta, is material accounting policy. This one I'm going to whip through. The concept of you don't have to do significant accounting policies anymore. You actually only have to disclose material accounting policy information. So this is part of the declutter process. Bring those policies down, focus on what's entity specific and policy choices rather than putting gobbledygook in the financials that's really just a copy and paste from the standards. Not a new topic. Always a good opportunity to kind of just declutter those financials. And we do have some links to some articles there. In terms of, I'm not going to do this later. I think in the interest of time, I'm gonna skip over that. I want to do, and yeah, some articles we've had lots of ways to declutter your financials all the way back to 2021. So not a new topic. I have actually done an entity recently. I was involved with a client where we helped them declutter their financials on the materiality. This was only about 3 months ago. And we, first of all, they had 23 pages of accounting policy. Way too many policies, 23 pages. We were able to take that down to two pages. And we put the key policy judgments in the relevant note. Great outcome for the client. And actually, the Audit and Risk Committee said to me when we presented it to them, no one knew how to engage with the financials every year because it was just too much. Thank you for making it simpler. And then they were able to actually have a conversation about what the financials were saying to their investors, which is actually quite scary because that means they were issuing financials in previous years that honestly nobody was looking at. So they actually got a better outcome. In terms of Pillar 2 income tax, look, this has been plodding on for a while. This is the concept of the Australian government committing to the Pillar 2 for large multinational entities. What it's basically trying to do in its substance is essentially top up tax to a minimum of 15 degrees. That's globally. We're part of a bigger plan here. The idea of it is essentially to pay your fair share across all your jurisdictions. Australia plays a part in that. I'm not going to get into the 3 or 4 different types of rules and criteria that apply. I'll be honest with you, it's not my specialty from a tax point of view, but obviously it's going to fall into the disclosure and how you present that and report on that. Where it's up to is it's expected to pass the Senate by the end of the year. This is going to be one of those things that passes by the end of the year, is backdated retrospectively, and then we're going to be pushing into an election year and nobody's going to notice. But it's going to have massive ramifications, not only on your tax charge, because it introduces a separate tax system on top of to the Income Tax Assessment Act, and then we have to report that and disclose that and essentially grapple with it. So I'll leave it at that. Aletta, can you still hear me?
Yeah, Kevin, I can hear
All
you,
right,
and I
cool.
just wanted to add, it's really important to monitor. If you've got a 31 December year end, or you're doing half-year accounts, it's important to monitor whether this legislation, these bills, pass the Senate, receive royal assent before 31 December, because that would therefore be substantively enacted tax legislation, which will have an impact on AASB 112. And I think the chances are really good. So just keep an eye on that. We want to put it on your radar.
That's why I called it a sleeper letter. It's one of those that suddenly is just been passed. And I will say that BDO will issue an update through our corporate reporting system as well as our website and thought leadership. So just keep an eye on that. And then we also have some articles here. And you can see that the articles we have up there link back to 2023. So it's not new. It's just going to trigger probably by the end of the year, and then be straight in. Right. Moving back to some of our other ones, and these are going to go really fast. Contingent considerations to vendors in a business combination. It's kind of funny how this one too, this is not new, but the concept of acquiring a business and paying either shares or additional amounts of money after the acquisition based on hurdles or outcomes has always been treated as a deferred part of the consideration. But if you start to really get into the detail, you need to kind of understand what the deferred consideration is actually for. Now, it's not new, but it's become really clear to us in the last few weeks and months that a lot of mergers and acquisitions out there are actually paying different parties for different things that are not actually related to buying the business. And the key one is when you pay employees for services after the acquisition, but it's part of the business combination agreement or the purchase agreement. Those are actually not part of the acquisition of the business. They are actually additional consideration to, for example, employees for services after the acquisition. So they're share-based payments, and they need to be accounted for in a different way. If you get that wrapped up, you get your goodwill wrong, but also your post-acquisition expenses end up being wrong because you're not accounting for the substance of the arrangement, which is you've essentially entered into a number of arrangements with different parties, and they're not all actually for the acquisition of the business. They might be linked to the acquisition of the business, but they're actually for services and for something else at different times and with different parties. So please make sure that when you are executing a sale and purchase agreement and you're accounting for this, make sure you clearly identify the components of the transaction, which ones are for something other than the business purchase itself, and when are those accounted for and with whom. And that's really the key thing. Yeah, and like I said, not new, just interesting that came up again. It came up by way of an IFRIC agenda decision. Nothing new, just clarified. That was in 2024. We've got an article linked to that. But I actually think that the issue isn't new and it shouldn't be missed. Right. Cash considerations. The issue here is whether your bank balances and overdrafts facilities actually are cash and cash equivalents, or whether they're borrowings or something else. The definition of cash and cash equivalents: short-term, highly liquid investments that are readily convertible to known amounts of cash, subject to insignificant risk of change, and held for the purpose of meeting short-term cash commitments rather than for investment or other purposes. The key one that we keep running into is the example of a 6-month term deposit. A 6-month term deposit can't be held for short-term cash commitments because it's not accessible, and it's obviously been put there for the purpose of a higher interest yield, so it's investment purposes. But somehow it finds its way into the cash and cash equivalents part of the financials, which then gets reconciled to the number at the bottom of the cash flow statement. That's fundamentally incorrect, and we just want to kind of bring that to your attention. Also, nothing new, but wow, has that been missed quite substantially in terms of presentation and disclosure. And this is also extends to essentially any cash and cash equivalents subject to restrictions, including those in other countries. Cash that's locked in a country, in another country that maybe has tight restrictions on accessing that cash, could actually change the classification of it, which then changes the presentation in your financials. Why is this coming up so much? Also because IFRS 18 is in development, which changes some of the presentation in the cash and cash equivalent. And then through the drafting of that standard, IFRS 18, everyone noticed that even the basics as they exist currently in the standard, people were getting those wrong. So just go and have a look at that and make sure you're getting that right. Some links on the next slide to some of our resources. And then common disclosures in financial reporting. And Aletta, we're almost there for a sustainability update. I actually did these in detail, or at least some of them in detail at the 30 June update. And then there's been a corporate reporting insight that we've put out since then in October 24, so a good link. But really, some of the things like the public company consolidated disclosure, already done that earlier. rounding. We did a great session on this at 30 June on rounding, just making sure you're getting your rounding correctly under the ASIC regime. The rounding isn't just how you round to the nearest dollar or thousands of dollar. There's actually different rules on how you round your earnings per share and how you round information in the director's report and remuneration reports, and the rounding conventions are different for some of those. So in some you round to dollars, some you round to cents, some you round to 1/10 of cents, and it's not a free for all across the business, across the financials, and it's not a consistent thing across the financials. So just go back and make sure you're getting the rounding right, especially when it comes to share-based payments, earnings per share, remuneration reports. Those are different to the way you round, let's say, in the actual body of the financials themselves. And we've got some good links to that. The other one I'll pick up from here is discontinued operations. Entities are still classifying discontinued operations too soon. There are very specific rules about when an entity can classify an operation as a discontinued operation, and I think entities often classify them too early and then get the presentation right. This is not really an accounting construct, it's a business construct. The discontinued operation determination is linked very much to where the operation is in terms of the director's approval for disposal and for sale. It actually happens in the boardroom to get this classification right. It's not something that the financial controller or the finance team should be doing without understanding where it is in terms of the executive and the board decision making, because you can't really classify something as a discontinued operation if the board hasn't decided to sell it yet. That's really important there. And then deeds of cross guarantee, the exemption on wholly owned subsidiaries not preparing financials because the parent is preparing consolidated financials when there's a deed of cross guarantee is true, but there's some very specific rules about when that can happen. And also there's some very specific disclosures that have to happen when the group that's in the consolidation is slightly different to the tax consolidation group and the so-called closed group mechanism. So it's not as simple as I'm not preparing financials and therefore I've just got consolidated financials. You actually have to make sure the groups are aligned in terms of what's covered by the deed, how that links up to closed groups, and then have you actually satisfied all the disclosure requirements to actually disclose the risks around that for all the entities in the group. So we'll leave it at that for you on those. And then some of our other common disclosure, I've already mentioned them already, but the remuneration report, just remember that has to be audited and there's no real materiality in the remuneration report. Things have to be disclosed in the remuneration report. Don't hide behind materiality there either. You've got to get that one right. That, Aletta, sets you up for taking over a little bit to talk about sustainability. Also important for 31 December.
Thank you very much, Kevin. Thank you very much for doing that and for the overview. You know, I think I've talked about sustainability as part of this update for many, many years. And I think I'll continue to do this for many, many years because we know that the two worlds are colliding. Financial reporting and sustainability reporting are going to sit side by side in an annual report. I want to recap a few issues, and that is, when we look at sustainability at BDO, we use sustainability and ESG interchangeably. And I actually like this ESG concept because it gives us the ability to explain what environmental topics, social topics, governance topics are all captured and embraced within sustainability. And we've only picked 8 common environmental topics, social topics, and governance topics. But I think that the other question that I've been asked a lot recently is, Aletta, you talk a lot about mandatory climate reporting under AASB S2. Are there any other mandatory requirements around sustainability? And the answer is yes. And the one is around, if you're above a certain size, the modern slavery legislation would impact you, and you need to prepare a modern slavery statement that go on a public record. So look out for the size criteria and how that interacts with mandatory modern slavery statements. The other thing to look out for, also linked to size criteria, is payment times reporting scheme, which really sits under governance, and ethical behavior around, are we paying, as big organizations, are we paying smaller suppliers in a timely fashion as articulated in our payment terms? The payment times reporting scheme, I've had some discussions with clients this week, is actually during this year changed. And there's some changes on who has to report, and if you're part of, and if you are being controlled by another entity that is reporting, how you can get relief. So please revisit those changes to payment times reporting scheme as well. The other one to think about that is potentially applicable is when you look at the WGEA, the diversity, gender diversity disclosures. Again, if you're above a certain size threshold, you've got legislation requiring you to prepare that reporting. So there are other mechanisms in place to mandate, so other mechanisms / legislation in place to mandate reporting of certain aspects. So, and I just thought I'll flag that today. So if you look at international and Australian sustainability disclosure standards, yes, when we look at that perspective, we only have the two, AASB S1, the foundation standard, which is voluntary, and we've got AASB S2, which is looking at climate change, which is mandatory. We expect rapid fire standard setting. We expect a standard on biodiversity. We expect a standard around the broad workforce as well. I also think it's a good idea to just remind you, a lot of entities are saying, if we measure our carbon footprint, which is a big focus at the moment, if we measure our carbon footprint, would that put us in a good place to say we are now ready to comply with AASB S2, climate-related disclosures? I would say you're potentially halfway there, but there's a big gap still to fill, and that's all the governance disclosures, strategy disclosures, risk management disclosures. So you will still need a climate, a risk and opportunity assessment, a scenario analysis, financial modeling. There's a lot of disclosures. Carbon footprint is important. It's time consuming. It's difficult. It's new, but it doesn't get you to compliance with AASB S2. So that's just a little bit of an introduction across sustainability and things to think about. Why do we continue to talk about sustainability? Because it's off the charts important as we speak. If you look at the specifics of the why, I think the more important reason is the strategic imperative, the commercial importance, the business importance around sustainability. However, what is really driving action at the moment in Australia is this compliance imperative. Everybody is aware of legislation, of the potential mandatory reporting around climate that is hitting for years, financial years beginning on or after 1 January 2025. But please don't take your eye off the ball. There's strategic value in doing this as well. So I just want to explore this and do a recap of this incredibly important strategic imperative. Some of our smaller clients and medium-sized clients and their BDO partners often challenge me, Aletta, why do we have to look at sustainability? And I think, Kevin, we've put that to bed now, because we've been saying to them, listen, if your client don't need investor money, if your client don't need financing from banks or other parties, if your client don't need customers, and your client don't need people to work in their business, they don't need to speak to Kevin and I around sustainability. But it's really hard to say yes to all of that, because every business needs customers or clients. Most businesses need people to work in their business, and people need money, whether it is a not-for-profit needing a government grant, whether it's an investor money, or maybe we might need investor money in future. We might not have debt financing at the moment, but we would want to get it in future. Or I want cheaper debt financing in future. So it's all about access to capital, to markets, to people. Incredibly important to remember this. This is the commercial reason you're looking at sustainability. I want to attract investors. I want to IPO in future. I want to get cheaper loans. I want customers to buy from me. A lot of customers have changed supplier selection criteria. They've added sustainability in the mix, often measure carbon footprint, set targets, track progress. Often they want assurance over that as well. And if you want to continue to supply to them, that's what you have to do. This is a reality, Kevin. This is the example, this strategic imperative. I did not appreciate, and I'm honest, I put up my hand, I did not appreciate how draft legislation on the 12th of January and compliance and mandatory reporting can be so powerful from a strategic imperative. Because those big entities that have to do mandatory reporting, the banks who have to report financed emissions, and on all those entities looking at scope 3, the pressure from a compliance perspective, how they flow through the whole value chain, has been extraordinary and extraordinarily fast in 2024. So please consider the strategic imperative. Before you ignore sustainability, before you turn a blind eye to sustainability, consider where your business fits into the economic system, the ecosystem in which it operates. What are the potential pressures on the people in your ecosystem, and how would those potential pressures impact you? You know, sustainability is a team sport, and therefore, if some of your team members are impacted by this, they would ask you to assist. So this is incredibly important. Please don't ignore this. I also want to say something else. If you do not believe in climate change, if you do not believe in any of these sustainability measures, it's irrelevant. We have to move on. Whether you believe in climate change or not, there are now requirements to measure and disclose information that will impact your business's ability to continue. So it's really important it's no longer an argument whether we agree with climate change or not. That's not the argument. It's how does it impact the business, and how does it have to be reported. Just another reminder, we've prepared a document, a checklist to help you start to think about sustainability around, I call it a baby sustainability strategy on how we look at what we have in place, what stakeholders want, identify the gaps, decide to measure and address them gaps, and you can have a look at that. Now, I've thrown this slide in here because it's a reminder for myself that each and every time, it's a reminder to share with you that each and every time we do a sustainability strategy with our clients, and in particularly, we do a materiality assessment, which would involve quite often doing stakeholder engagement. It could be surveys, it could be workshops, it could be desktop reviews of our stakeholders' publicly available information. Every time we do that, and we ask them, there are all these sustainability topics. What would you like our client to focus on? What information would you expect them to focus, to measure and report to you? Each and every time, the answer that comes back from each and every stakeholder, we want you to measure your carbon footprint, set targets and report that to us. Each and every stakeholder of every client. You know, and that's why, you know, I've often been saying all paths lead to carbon accounting. Incredibly important that whether you look at this strategically to continue to do business, or whether you look at it from a mandatory reporting perspective, you have to start with measuring your carbon footprint, and not just scope 1 and 2, also scope 3, in order to fully inform your ability to set targets, and your decarbonization strategy. I also want to say, if your business have been reporting emissions under the NGER scheme, a lot of those clients say, Aletta, we've measured scope 1 and 2 under the NGER scheme. Please help us with scope 3. I say, hang on, stop, let's back up. NGER scope 1 and 2 is not necessarily and always the same as scope 1 and 2 measured under the greenhouse gas protocol. I'm not saying do it over or redo it. All I'm saying is do an assessment of whether for your clients, for your situation, it's the same or not, and whether you need to top up. So questions like, did you pick up all the facilities? Because greenhouse gas protocol, you have to pick up every facility despite threshold. Did you pick up every greenhouse gas at every facility? Because again, greenhouse gas protocol, we don't look at thresholds. If you've assigned reporting obligations for certain entities where you have operational control to another entity for whatever reason, which is acceptable under NGER, it's not acceptable under the greenhouse gas protocol. NGER is looking at facilities, greenhouse gas protocol is looking at the reporting entity, everything in the boundary. Have we done that? So these are things to think about, and potentially you need a bit of a top up on scope 1 and 2. So measuring your carbon footprint, incredibly important for strategic and compliance purposes. If we look at compliance imperative, we know from an international sustainability standards board, they've got 2 standards out. S1, a foundation standard, S2, looking at climate. I've previously shared they are working on biodiversity, which might be S3, and workforce, S4. We are expecting rapid fire standard setting because in Europe they have 12 standards. Our European colleagues, and I was in a meeting last night with them, they are really under the pump because the large businesses in Europe have to, for the very first time, comply with those 12 European standards by 31 December this year. And remember, most entities, they have a 31 December year end, and they need assurance over it. The panic station is crazy. So I'm really keen to, in February, March, look at the reports that they publish as good examples for us, see what we can learn from those, and we will share them in webinars, of course. But in Australia, 2024, it was really on the 12th of January, Kevin, I was in Canberra supporting my daughter playing in a hockey tournament, and this happened. And I'm going to end the year, by the way, in Canberra again when she's playing hockey again, you know, so I start my work here in Canberra and I'm ending it in Canberra. In this
Every time
legislation...
Aletta goes to Canberra for hockey, we have more work to do.
And then there were 4 big things there. There was the separate sustainability report, in an annual report, equal prominence to financial report. We will need assurance and by your financial auditor. Those were the key things. That draft legislation quickly became, relatively quickly, final legislation just before Easter weekend. They do like public holidays and long weekends. So that's why, you know, our other legislation around Pillar 2 will come just before Christmas, right? Because the intention is to destroy our holidays, I think. And then we have a trifecta now. We waited quite a while for this legislation to move through both houses of parliament and to receive royal assent. If you think final legislation was tabled already in March, a royal assent received on the 17th of September, and it is at a Senate level. There were a lot of debate on whether it should apply to Group 3, whether it should include Scope 3. The answer is yes to both. The one change they made in Senate was around scenario analysis and mandating 2 particular scenarios in Australia. In that week, AASB S2 was published, and the mandatory standard. AASB S1 approved and published as well, but is voluntary in Australia. And then to finish off the trifecta, the International Auditing and Assurance Standards Board issued the International Sustainability Assurance Standard, the 5001. And in Australia, our Auditing and Assurance Standards Board, right-hand side at the bottom, issued an ED on how they propose to phase in assurance in Australia. I won't discuss this in detail. From a size perspective, when will you have to do this mandatory sustainability reporting in your annual report? It depends on whether you group 1, 2, or 3. If you meet criteria 1 or criteria 2 or criteria 3, you captured. If you look at criteria 1, there's 3 aspects. If you meet 2 of the 3, you're in, you're it. And we've prepared a decision tree to help businesses, because this is the first and foremost question. Does this apply to me? And if it applies to me, am I group 1, 2, and 3? And therefore, when does it apply to me so I can get ready? So the very first question, and this is incredibly important consideration, for every entity in your group, you have to ask, is the entity lodging a financial report with ASIC as required by Part 2M of the Corps Act, not other parts, Part 2M. So you will be looking at public companies, large private companies, etc. If you say no, you're out from mandatory reporting. I will say this, you're not out from the strategic imperative to measure your carbon footprint, but you're outside mandatory reporting AASB S2. Even if you say, yes, I'm lodging, there's also a section in section 292A, paragraph 2. Is the entity a subsidiary whose ultimate Australian parent entity, so not ultimate parent outside Australia, ultimate Australian entity, prepares and lodges a consolidated sustainability report with ASIC? Because if that is the case, that entity, that subsidiary, don't have to do mandatory sustainability reporting. Now, that statement, there's a few questions there. I would imagine if I'm a parent, I will have to do a consolidated sustainability report always, but that's a different matter. There's a little bit of discussion around exactly what that means. But if you say no to that, then we start to look at whether I'm group 1, 2, and 3. If you have a 30 June year end, you group 1, it means first cap of the rank would be 30 June 2026. However, if you've got a 31 December year end, we are looking at 31 December 2025. That's next December. You would be the very first organizations in Australia to do this mandatory climate reporting. So we're currently working with a lot of clients that have a 31 December year end. They want to do a dry run for 31 December 2024 to show the directors and show everybody what it's going to look like, identify weaknesses, identify data gaps, so they've got a year to improve and get ready. So that's a very important exercise, and I would highly recommend that dry run. Assurance, I should start first of all, what's the difference between limited assurance and reasonable assurance? Very basically, reasonable assurance is the highest level of assurance an auditor can provide. That's where they do full audit procedures, including sampling, substantive testing, etc. Limited assurance is where you do a review, which is looking at processes and systems and discussions with management, not necessarily reperforming calculations, not necessarily doing sampling. So what they're proposing in Australia is that we do an initial limited assurance review, which will ultimately become reasonable assurance, full audit over everything. If you look at that very first year, I want to explain that first year. If you are doing mandatory sustainability reporting AASB S2 for 31 December 2025, your first year, you have to disclose everything in AASB S2, but you have an extra year for scope 3. So you have a delay around scope 3. In that very first year, you don't need comparatives. In your second year and in future, you will need your current year and your comparative year. In that second year, because it's the first time you're including scope 3, you won't need comparatives for scope 3 in that particular year. But from year 3 onwards, you will need current year, comparative year for absolutely everything. From an assurance perspective, Remember, in that first year, you have to disclose everything except for scope 3, but not everything will be subject to assurance in Australia. So there will be, this is a proposal, it's not final, there will be limited assurance across certain aspects. So they're trying to phase it in and provide some relief. The other thing to consider, there's also some limited liability or some relief for directors across certain aspects for a short period of time. So that is important to look at the legislation and put that to the attention of directors as well. So if you look at your annual report, we'll have the financial report, sustainability report, director's report, audit report. You can see your financial report, sustainability report, equal prominence. I think it's important to consider how all of this fit together. Some clients are also wanting to report a lot of other sustainability information, and they want to throw it in the sustainability report, in the annual report. And my question would be a bit careful, because that sustainability report in the annual report, it's defined in the Corps Act, will be subject to assurance. If you want to keep the other sustainability information, maybe around diversity or all those other topics outside of the report that's subject to assurance, put it in a separate supplementary voluntary report, which could be in or out the annual report, but just create an ability that you can say, auditor, audit financial report, audit the mandatory sustainability report. We are also going to put the other voluntary information in, but it's not subject to audit or assurance. And maybe the easiest way is to have it completely outside the annual report, and that will also give you some relief around staffing, because it doesn't have to be published at the same time. But over time, everything that's sitting in that separate voluntary report will move over to the mandatory report as they issue IFRS S3, S4, S5, etc. If you look at AASB S2, just want to make the point again, there are 4 pillars of disclosures across governance, strategy, risk management, metrics, and targets. There are 191 specific disclosures across these 4 pillars. Carbon footprint and setting targets are 2 blocks of the 11 blocks on the screen. So if you've done carbon footprint, you've done a lot of work, you're doing great, you're doing it for strategic purposes, great, but you have a hell of a lot more to do for AASB S2 purposes. And this is similar to what we've seen under TCFD, and I'll end with this. If you've got a 31 December year end, you will have to do mandatory reporting 31 December 2025. You have 12, 13 months, 12, 13 and a half months to do a lot of things. And we've tried to list them here. And we've said the 2 streams that are compliance focus is carbon footprint and then the other climate related disclosures. Carbon footprint is a separate project stream because often driven by the finance team, making sure completeness of data, etc., position papers, and I've got the bullet points there. I would say that is 50 to 60% of your cost and effort. The other 40 to 50% sitting in climate-related disclosures. Have you done a climate risk assessment? Have you done scenario analysis? Have you done the financial modeling? Have you done a dry run? And, are you assurance ready? The third stream is if you look at this strategically. So that might not be your mandatory focus. If you look at it strategically, I know you look at the strategy and quickly also do project stream 1, which is measuring your carbon footprint. If you've got a 30 June year end, extra 6 months. Kevin, I think that was high level, but still a lot of content. Please reach out if you need guidance on this. Kevin and I are doing a lot of complementary board education sessions, audit and risk committee education sessions, executive education sessions. If you can give us 15, 20 minutes, we can get sustainability finance boards, audit and risk committee on track to understand what next steps are, including the roadmap. So please reach out. Kevin, I've given you exactly 8 minutes to do the
Yeah,
flyover of the other items. Good luck.
not a challenge at all.
Kevin, I can't hear you now. Are you there? Have you muted yourself maybe?
I am here now. I may have been muted for that, so I will say it again. Thank you, Aletta. As you will know, Aletta and I normally leave the last part of this section as homework. There's a lot in here that we have already done before multiple times during the last year of webinars, and there's a lot in here that isn't relatively new, and there's a lot in here that there's lots of thought leadership information available on the website. So we're going to do a very high level, almost a scan of the slides. I'm not really going to stop. We're just going to kind of click through and tell you what's happening here. So the first one is classification of loans as current and non-current. The short answer here is that this is the first time application for December year end, so the standard is effective. So 31 December 24 is your first year that you need to reassess and get right your current and non-current liabilities. You will have a comparative restatement, so you've essentially got an opening balance sheet of 1 January 2023, and you're in. The decision tree in this publication is where all the fun sits, which I think is on the next slide, Aletta. And this basically helps you understand how to evaluate your current and non-current assessment, factoring in things like covenants, rollover rights, waivers, and periods of grace. Those sort of 4 concepts. There's lots of diversity in practice that existed before this amendment or this standard. So now what's happened is the amendments to the standard have essentially brought into the standard how to deal with those concepts: covenants, rollover rights, waivers, and periods of grace. So if you have any of those 4 things, covenant tests, rollover rights, waivers, and periods of grace, make sure you are reassessing whether your classification between current and non-current is correct. Wonderful decision tree. If it's not correct, you have to adopt this in the current year, 31 December 24, and you have to restate into the previous year too, which also means you have to reassess how you did it last year and whether that was right, if you had those 4 characteristics. Lots of links, there's a publication, and there's lots of webinars available to you on this information. Then heading towards the next section, standards applicable for the first time for 31 December. The big one is the one I've just mentioned, which is classification of liabilities between current and non-current. This standard went through a number of amendments, updates, but essentially the whole suite is effective for December 24 year ends. I think that's all you need to take away from that. And then we've got supplier finance arrangements, other amendments to lease liabilities and sale and leaseback, and public sector entities. Now, we do actually have some slides here. Let's go through them quickly. Supplier finance arrangements. This one is, let's just kind of jump through it. This one is more, I want to say, disclosure if you have these arrangements, and also effective for the first time 31 December 24. I think the next slide is actually the one to head for. What is a supplier finance arrangement? It's essentially when you've got a finance provider providing finance basically into your supply chain, often called reverse factoring arrangements. The best I can say about this, because the topic is too big to deal with in the webinar, but it's essentially if you are essentially backfilling finance through your supply chain, in other words, essentially integrating supplier finance in a reverse factoring arrangement, your disclosures will change in the current year because it's essentially a borrowing in a way, and you need to evaluate that. You will know if you're doing this because essentially you're providing or getting credit through your supply chain. I think I'll leave it at that. There's actually too big to deal with in this forum, but it's effective December 24. Disclosures will change. You need to evaluate those arrangements. The lease liability and sale and leaseback, also a big topic. This is if you actually have lease liabilities or sale and leaseback arrangements. This was essentially an amendment that was driven to essentially make sure that when you account for the sale and leaseback, you don't get your profit and loss on the right of use element wrong. Now, if you have a sale and leaseback arrangement in place and you don't know what I'm talking about, then this is for you. This is a self-study homework. And this also would apply some sort of assessment to leaseback transactions that have actually happened in the past. So you need to reassess essentially your sale and leaseback accounting on that one. And then the fair value measurement guidance for the public sector, running at a pace, Aletta, to the next slides. This is actually an Australian specific guidance in the not-for-profit sector. This is in the not-for-profit public sector. This is essentially how do you measure fair value for assets in the public sector that are measured on a, shall we call it, a current use or replacement cost basis. And this is because you really don't have a market to reference the value of those assets to, so you can't apply an income or a market-based measure to them. This is actually Australian specific, as I've mentioned. So it does have only a niche application, but it essentially clarified all the issues that the sector was having in the past in using the, shall we call it, the cost-based measures of fair value. So there's lots of guidance in here about determining highest and best use in the concept of a public sector asset. It provides lots of guidance and illustrated examples around the replacement cost method and how do you actually have access to a reference asset when you do that. And it also explains concept of economic obsolescence. I think the way you would use the standard is you probably would already have a lot of guidance if you're in this sector, especially from some of the government treasury departments sort of issued guidance on this. But it is true that it does apply to some not-for-profits that wouldn't necessarily have access to those sorts of guidances or accesses to those sorts of treasury functions in government. If you are fair valuing any asset in the not-for-profit sector and you are using a cost-based measure, you should dip into the standard to make sure that the way you are measuring those assets under the cost-based fair value models, you're doing it correctly. And if you are using an external valuer to value these assets on a cost-based fair value method, make sure the valuer knows about the standard. If the valuer doesn't make reference to this standard in their valuation report, either get another valuer or make sure he gets a copy of this to incorporate into his valuation, because he should be testing his methodologies against this standard to make sure those valuation concepts are being adopted in accordance with this standard. I think I'll leave it at that in terms of that topic. Any comments, Aletta, on those three topics that you might want to just kind of point out?
No, I'm happy with that, Kevin. I know we've got a timing issue, so I think we leave it at that.
Right. Now, from this point forward, I might even get Aletta. She may even just kind of tap the move forward button, and I will talk while she's doing that. I've got the slides in front of me, so I do actually know what's coming up next. But essentially, these are your forward-looking standards. So primary financial standards, AASB or 18 or IFRS 18 is in future years. However, you should probably be disclosing the impact of it in your current year. And that's the same for other standards and effective, not yet effective, which are coming up, making sure you're disclosing the impact of those for future years. And this is where we get into things like lack of exchangeability, classifications on financial instruments, and annual improvements. I'm actually going to do none of those because that's a bit of a self-study. That's more disclosure and disclosing the impact of those standards. And it's not as important as adopting a new standard in the current year. Well, I shouldn't say it's not important, but it's not as important. IFRIC decisions, a long list of IFRIC decisions that have come out recently, or over the last 18 months or so, that are all relevant. If I have a look at what's going on here, notice the one at the bottom in red, principal and agent in software resellers. gee, doesn't that align nicely to what the ASIC regulation are looking at? But there's many things in here that essentially interprets issues in IFRS, that the IFRIC has issued final agenda decisions, and you know what that means. If they've issued a final decision on something and the fact pattern applies to you, you should be adopting that and applying that in your financial statements basically immediately, or as soon as possible in your next set of financials. There's nothing on this list that I think I want to point out that we either haven't already spoken about. And so I'll let you go through that yourself. Lots of interesting topics. They're quite niche, but if they apply to you, you have to consider them and roll them in. Aletta, I don't think there's anything else on the IFRIC I will deal with. Registered superannuation issues and the hyperinflationary, those are quite niche and specific. Some self-study there. Generally with the hyperinflationary economies, you need to have a look which economies have been added to the list. So if you're doing business in any economies, and that's really Malawi and Laos, you would be having to account for them under the hyperinflationary economy concepts in IFRS. That was updated in November 24, but there are some new economies that have been put on the watch list, which means keep an eye out for them because it could move you into hyperinflationary accounting in the near future. Only 3 minutes over, Aletta. I'm going to say thank you to our attendees. It's been great to do this at a sprint, and we will see you. Aletta, I'll hand over to you to do the close off next month.
Thank you very much. Thank you very much, Kevin. I mean, a lot of these topics we've previously discussed. It's a wrap up of all the things to consider that might impact you for 31 December. We've tried to discuss the big items, the new items, but please work through those links. Let us know if we can help you in any way. And we're looking forward to speak to you in December to give you a bit of an insight over the brand new IFRS 18 and AASB 18. Thank you very much. Have a great day. Thank you, Kevin.
Goodbye, Aletta. Goodbye, everyone.